Well, welcome back to part 2 of our conversation with Greg Holst from JPMorgan on fixed income. This week, we're going to talk about where we've been and where we might be headed. So Greg, last week, if you didn't catch last week's video, highly encourage you to go back. We talked about not only Greg's role, background, kind of how JPMorgan thinks about fixed income in general. There's a link in the written. This week, I want to talk about really a little bit, stepping back a little bit more broadly. How does JPMorgan, or for that matter, I mean, I know it may differ, how do bond managers seek to add value to a bondholder of one of their funds?
Yeah, that's a really interesting question. And we think that managing bond funds, this is an area where active management can play a large role. So when we look at the bond market, nearly half of it is not in the primary index that we use to track the bond market. That index is called the Bloomberg US Aggregate Index. But that means that if half of your universe is outside of the index, that means an active manager can make a lot of headway by selecting some of those bonds as it makes sense and stepping outside of the index to do that. And those are in areas like, we call it securitized credit, but these are things like asset-backed securities, commercial mortgage-backed securities, non-agency mortgages, things like that. But there's also ways to step out in corporate bonds and in agency mortgage bonds, and even on the margin in treasuries. So that is something that we can do. Now, I will say that the particular group that I'm most associated with, we manage core bonds, and they add a lot of value. They come in every day. There may be something called a bid list where somebody else is selling a bunch of bonds. They'll look at several hundred of them, look through the list. Maybe they're interested in 20. They'll start testing these bonds and putting them through their models. Maybe they end up bidding on 5 or 6 of them, and they end up getting 1 or 2 of them. It's very time intensive, but it is a way to get a lot of bonds, good bonds, and get them cheaply. And so that's how we think about it.
Interesting. A question I get, it's a great question. I don't know that I have a perfect answer for it from clients, particularly when we're reallocating, tilting, we call it, not timing. But that adage of, okay, I keep hearing from you, if I'm speaking as the client, you can't time markets, you can't time markets, you can't time markets. You and I were just chatting, we're not making yield calls. How would you describe that ability of reallocating, tilting a little bit more into one asset class versus another within, again, the fixed income universe, versus trying to make calls, trying to time the market? How do you and your team reconcile that potential, but not necessarily dilemma?
There are some managers that spend, and others, that spend a lot of time trying to figure out how to be in the right place at the right time. And that sounds good. It really does. And I could see to your clients how they could say, yes, I'm going to hire somebody that's very smart and they're going to know exactly where to be at the right time. That does not exist. I'm here to tell you. And so what you really want to do is you want to come up with a solution where in the vast majority of outcomes, you can win. So you may make little calls around the edges. You may decide to take the maturity up a little bit or down a little bit. You might want to, add to your corporate bonds or subtract from your treasury bonds. So these are all things where you can add value around the edges, but you are not going to make wholesale changes to the portfolio because that's when you tend to get into trouble.
Yeah, there's a lot of, to me, anecdotal things. For one, I'm always, telling clients, and myself for that matter, if you want to do it too strongly from an emotional standpoint, or it feels too easy, you're probably getting into market timing, right? Trying to chase a market higher, panic near a bottom. If it really makes your gut turn a little bit to take the action, you're probably being prudent.
You're probably doing the right thing.
as opposed to doing the right thing. Plus, I think timing, but to your point, begets, I'm going to be in the right place. I'm going to make the right call, where I think, at least how we think, and what I heard you talk about is, you can probably weight probabilities.
Yes.
You're still going to eat dirt a good amount of the time, but you accept that, but you're always shifting to hopefully have those probabilities break more times than not. Talked about having a look back. put into context, I think a lot of people might know their bond portfolios suffered in 2022, but maybe explain for those who don't understandably understand the gravity or even the historical context of just what went down in 2022 from a bond market perspective.
Yeah, 2022 was not a good year in the bond market. And it has to do with a Fed who is very active around the time of the COVID crisis in bringing down interest rates. And they brought them down to very close to zero in policy rates. And that means that a lot of the bonds that we were buying, which are a little longer, they may have had a yield of 1 point something, sometimes even 0 point something. It was not very much.
At or below 50 basis points? I mean, it was incredibly low.
Yeah, that was a day.
The depths of COVID.
That was definitely. I remember that day very, very well. I was on the road that day, and I remember looking at my phone, saying, "What is it now? What is it now?"
I've come to find you're almost always on the road when there's going to be a historic day or a historic need from someone. That's just, I have a lot of trepidation of leaving town.
Rates were very, very low, and suddenly the Fed realized that inflation was getting out of control and that they were behind the curve, so to speak. So they started raising rates, and they raised them fairly quickly, and they raised them fairly high in a short amount of time. And what that means is that bonds, for instance, I mentioned in the last video, I mentioned the U.S. aggregate index. It was down 13%. That's never happened before in modern times.
I think treasuries, I read somewhere, were down at depths not seen since like the Civil War. I mean, it was
historic.
Yeah, it was historic.
It was historic. But when rates go up like that, suddenly there is an opportunity, because rates probably aren't going to go up more from here. And you have real income now. You're having 4, 5, 6%, depending on what you're investing in, income on a lot of your bonds. So it's actually led to an opportunity, but it was a painful time for sure, Tim.
Let's talk about where we go from here, because from that carnage comes opportunity. So how should people be thinking about fixed income markets today? Like a lot of things, I think people give them up for dead after a really tough time, but you mentioned some potential opportunity now for people. Yeah,
absolutely. There is right now. Going forward economically, we think that the growth will continue to happen, and that the Fed has actually landed the plane pretty well. So you hear people wondering about that. We think that we are in this period of what we call sub-trend growth, and that's actually an ideal time for all kinds of bonds. My boss's boss, there we go, he actually often will talk about, right now he's talking about ABC, anything but cash. Because right now, people have been in the front end of the curve, they've been in cash, making 5%, very happy about that. Well, we've already had a 50 basis point reduction in policy rates that plays out directly into the cash bond markets. And then, we expect another 200 basis points, and the market expects another 200 basis points of additional cuts. That's going to push money out the curve into other areas. And so what does that mean? That means there is opportunities in longer duration bonds. There are probably opportunities in bonds that have a little more risk, and that could be surprising to some people because they're not trading with a lot of extra yield right now. Sometimes we call that spreads over treasuries. They're not trading with a lot of extra spread, but we're in what seems like a very good environment. And we think that they could stay tight or even tighter, those spreads, for quite a while.
I know we talk about this with clients all the time. There's always something to worry about. Probably seen those charts, usually overlaid with the S&P 500 of all the various headline news that have gone as the things have gone up over time. One of the things that was talked about a lot within real estate, fixed income, any kind of a loan was reissuance concerns. Oh, all this debt's going to mature. People aren't going to be able to reinsurance. That's going to be the shoe to drop that craters the U.S. economy. Well, we just got done with a month of record issuance, a lot of which was people restructuring that debt.
Restructuring and refinancing.
Talk us a little about, recent issuance, what seems to be maybe a lessening of that refinance risk as companies have been able to successfully do it.
Yeah, as long as I've been in the industry, people have been talking about big walls of refinancing that need to happen, and that it's going to be difficult to get done. And I have yet, I mean, yes, we go through periods of stress, but I have yet to go through a long period of time when that debt can't be restructured, can't be refinanced. And right now, corporate bonds, there's been an absolute wave of corporate bond issuance, and guess what? The market has risen up to take down that debt. There's been a lot of treasury issuance, and the market has come up to take down that debt. Mortgage issuance, that's not as much right now, but there is going to be some refinancings, and we're going to see that happening, and other things too. So I am not in the least bit worried about that. I've seen this movie before.
Well, Greg, we'll have to wrap it up there. We hope you've enjoyed this series. We talk all the time about great partners and the people who are working diligently on our behalf, and how the same way we ask clients to partner with us, we very much practice the same thing with partnering with people like you. So thank you not only for being here, but for all the work you do on behalf of our clients.
And we appreciate your partnership as well, Tim.